We are starting. So on behalf of Tata Steelium marketing team, a very good afternoon and welcome to all the participants of this webinar. We are delighted to have you here to participate in the webinar on GST, the next big thing in Indian taxation reform. Thank you for coming. Many of you have taken time from your busy schedule to attend the webinar. It's clearly an indicator of how important the subject is. And before I hand over to Mr. Ankit Kanodia, our speaker for this webinar on GST, he is a known personality on financial matters, an expert on indirect taxation, and is also a very well-known speaker and author. I want to say once more on behalf of the Tata Steelium marketing team, welcome to all of you. It's a pleasure to have so many of you here. Also, regarding your questions, you can type your questions on the screen and our expert will answer your question. And regarding the presentation is currently being shown on the screen. And also, you can get the presentation in the handouts that is on the right hand side of the screen. So the presentation name is GST underscore Ankit Kanodia underscore 19 August. So you can refer that also. So I would like to invite Mr. Ankit.
Good evening, friends, ladies, gentlemen, and all the viewers who are there. So the topic of discussion is the GST, the India on the brink of metamorphic tax and business reform, the goods and service tax law. See, the latest developments of GST, as we are aware of, that recently the Rajya Sabha has passed the GST with no vote outs, and also the same has been ratified again by the Lok Sabha. And next, the states, more than 50% of the states have to ratify the constitutional amendment bill before actually the GST comes into picture. So the states have also started with Assam being the first state, and followed by Jharkhand, Bihar, and now we are expecting by this month end Gujarat and West Bengal and another states would also ratify the constitutional amendment bill, so that the biggest taxation reform in the Indian taxation regime since independence can see a daylight. So we start with the presentation where the agenda is the different topics listed. I will be going through the basics of GST. What is GST? What is IGST? What is CGST? How would be the credit mechanism be moving? What about the transitional provisions? And how would it be impacting the customer as well as the ECAs, the emerging the emerging industries, and as well as every sectors. The basics of GST will be going through that. Plus, any questions if you all have, please write it down so that we will make it interactive, and the answers will be given as much as possible with the questions also. So firstly, we start, what is goods and service tax? As it states, goods and service tax is one indirect tax for the whole nation, which will make India one unified common market. It is a single tax on the supply of goods and services, right from the manufacturer to the consumer, means the whole supply chain, from the manufacturer to the wholesale dealer to the retailer and finally to the consumer. At each level, there would be a tax named GST on the value addition done by each of the persons. Similarly, the final consumer thus will bear only the GST charged by the large dealer in the supply chain with set of benefits at all the previous stages. As earlier I had said that it is the single biggest taxation reform. But personally to me, it is more than a taxation reform, it's a business reform. Why do I say business reform? Because the whole supply chain, the whole way the business is conducted, from logistics to procurement of materials to selling of goods to depot transfers and everything, would undergo a sea change. Compliances needs to be done, and accordingly also the IT systems would need to be upgraded to come into match with the GST regime that is being proposed. Why are countries adopting GST? The basic reason is that it is a uniform taxation to bring down the cascading effect. What is happening today? In today's regime, suppose I am a manufacturer and I am selling something to a dealer who is into another state, there is certain cost component of the tax which is not available as credits to the dealers. So it becomes a cost for the tax portion becomes the cost, and that dealer when further sells it to the customer charges tax on tax. Thus there is a cascading effect under the current value added tax regime that we are undergoing through. But the GST, the goods and service tax, as stated earlier, being a uniform single point of tax, single tax, would be levied at all the points, and thus cascading effect will not be there, as no tax on tax would be there. If at every stage, benefits of SENVAT credits, input tax credit, would be eligible to the dealers and thereby reducing the price at the end of the final consumer. Also, from government point of view, it provides steady and predictable revenue to the government because lots and lots of people will come under the tax net. Currently, in excise, we have an exemption threshold limit of 1.5 crores for small dealers, for small manufacturers. But under the proposed GST model, the draft law that was released in June, they are going with a slab of rupees 10 lakhs and a slab of rupees 50 lakhs for composition dealers, wherein they do not need to maintain any books of accounts. Just they have to pay flat 1%, 4%, or as the rates may be determined if the turnover of their turnover is below 50 lakhs. So you see, with current exemptions of 1.5 crore, they are proposing a threshold limit of 10 lakhs in the GST law, wherein n numbers of small buyers, the small players in the market, would also be coming into the taxation regime, the GST net, and thereby the database for the government to collect the revenue would increase. Of course, there will be a compliance cost also at the end of the government, but as per the statements given by the Honorable Finance Minister and Revenue Secretary, the cost of getting those revenues would not be higher than the revenue itself. Therefore, the proposed threshold limit as of now is rupees 10 lakhs and rupees 5 lakhs for the northeast states. All those dealers or manufacturers who have their place of business in northeast states, Assam and other states in the northeast, for them the limit is lower, up to rupees 5 lakhs. Just now, when we see how in India the GST has eventually grown up, so different finance minister statement you can view in your screen. These are all our statements of different finance ministers when they were presenting their union budget at that particular year. Finally, in 2014, the finance minister introduced the Constitutional Amendment Bill 2014, the 122nd Constitutional Bill, to bring in the single biggest taxation reform since independence. And this bill, after being introduced in the parliament in December 14, was passed by the Rajya Sabha on this month, 3rd August, with certain changes, and the same was also passed by the Lok Sabha with a pure majority on 8th of August 2016. So, Constitutional Amendment Bill has been passed. Why is Constitutional Amendment Bill necessary? Today, as all of us know, that state has the power to tax goods and the services are being taxed by the central government. But with GST coming into picture, there will be a dual levy. The states would also be empowered to collect tax on services, as well as the government, the central government would also be having power to collect levy and collect taxes on sale of goods. Of course, the central government is currently collecting taxes as excise on manufacture, but they would also be empowered to collect taxes now on sale. And in GST, they have used the term supply. So every supply, maybe of goods or services, would be taxable under the GST regime. Currently, the Constitutional Amendment Bill, since being passed by both the houses of the Parliament, will now have to be ratified by 50% of the state assemblies, and then it will go to the Honorable President for the ratification. Post which the GST Council, means the heart of the GST regime, the GST Council would be formed, and then the debates over the rates, the model law, the rules would be coming into picture, which we are expecting to be released by, at least the ratification can be done by end of September, and the draft rules, the formation of the council, everything can be heard of when the winter session of the parliament starts. Current patchwork India in India is like, in case of state VAT, or it may be service tax or excise, there are 4 or 5 type of players in the market. One are the primary producers, then who supply to the manufacturers. The manufacturer distributes the same to the distributors and the resellers, and similarly there are service providers who provide service to an intermediary named or service resellers, and there is a separate aspect of real estate, because in real estate they have a dual control. In some states they levy VAT and service tax both. In some states only currently there is service tax levied. In the proposed GST framework, all the 5 players of the economy, the producers, the manufacturers, and the distributors, the providers of services and the resellers of the services, along with the real estate sector, would be combined together to bring uniform taxation regime, as one and all the benefits would be shared between the each and every parties to the transactions. Coming to the further basics of the GST, as we know, GST would be a single uniform tax. So what are the current taxes that are being levied, which would be subsumed under GST? We will have a look at it now. Taxes levied by the central government currently: central excise duty, service tax, CVD on imports, cesses and surcharge, special additional duty of customs on imports, additional excise duties. All these taxes are being levied by the central government, along with the basic custom duty on import, as well as the central sales tax on interstate sales and purchases. When CST is being collected by the state government, but the levy is being made by the central government. How many of these taxes will be subsumed under GST? These are the taxes which would come under the ambit of the proposed GST regime. These are the excise duties, the service taxes, the special additional duties, the CVDs, and all the different cesses and surcharges. As regards CST, the same would be abolished in the GST regime, because there would be no concept in interstate trade. Also, there will be GST levy named as IGST, integrated GST, which would be fully submittable to the order to the dealers who purchase in interstate also. As regards basic custom duty, the basic custom duty would still remain, because the legislature intends to protect the interest of the local manufacturers, the domestic industry. If they remove BCD also, then the local manufacturers may take a hit, and the outside goods may become more dearer in India, and thereby causing harm to the local manufacturers. Going to the taxes levied by the state government at present, the taxes levied by state government varies from VAT, entertainment, local tax, entry tax, electricity duty, lottery taxes, state cession charges, road tax, stamp duty, purchase tax. In the GST regime, VAT, entertainment tax, entry tax, electricity duty, all the state cessions and surcharges are proposed to be subsumed under the GST regime, and all these will be termed as SGST. All those taxes in my earlier statement I told regarding excise, these would be in GST termed as central GST, or in short CGST, and all the taxes levied by the state government would be termed as SGST, which means state GST. As regards road and passenger tax, toll tax, stamp duty, these are more in the nature of, not in the nature of taxes, but in the nature of fees. And so these would continue to be levied by the respective state governments. And as regards purchase tax, they have proposed a system of reverse charge mechanism in case of supply of goods also, which is nothing but purchase tax, which is common in certain states now, wherein persons who are buying certain materials which are directly in relation to their provision of output goods or services, they have to pay certain purchase tax if they are purchasing that from an unregistered dealer. So to that extent, the current law gives us a concept of reverse charge mechanism in case of goods also. In case of services, it was already there. It is still being continued. But in case of goods, they are trying to introduce the concept of reverse charge, which may be in line with the purchase tax that currently many states levy on purchases from unregistered dealers. Next, we will have an illustration. We see an illustration of how the current system works in India and what are the possible taxes being levied. Suppose there is a manufacturing plant and this plant procures raw materials from three different sources. One is the import of goods and services, another is the interstate purchase of goods, and next is the local purchases of the goods and services. In case of import of goods, the taxes levied currently are basic custom duty being BCD, the CVD means the ADC, the additional duty of customs for the setup of excise, plus SAD to compensate VAT. Also, entry tax may be leviable in certain states when goods are being entered into the state from through port or through any other means. In import cases, entry tax is also being levied in many states. Similarly, there are local purchases wherein the plant has to pay excise duty, state VAT, or in case of services, service tax to their vendors. And in case of interstate purchases, the same is excise duty, possible entry tax, service tax in case of services, plus CST. Very important. Now, in interstate purchases, again C form, there is a CST being charged of 2%, which is non-sanvatable to the plant, to the manufacturer. So the first point of cost in the current regime comes up at the plant level in case of interstate purchases, wherein the CST is not available as credit to the plant. Now, after procuring these all raw materials, the plant manufactures the final product, and final product are sold through the depots or sales companies or through their stockyards. At the time of sale, they charge excise duty, state VAT, and if it is again an interstate sale, they will be charging excise and CST. Again, for the CST, their client or their customer will not be eligible to the said credit because it becomes a cost. In case of services, to transfer the finished goods from the plant to the client's premises or to the depots, the company has to incur many transport logistics expenditure on logistics, expenditure on handling of goods, insurance, and various other type of expenditures are there on which currently service tax is leviable. However, all this service tax being levied post manufacturing activity is not sanvatable to in many cases. In some cases, these are sanvatable if it is a FOR contract, but if it is a not an FOR, not a free on road or free on rail contract, then these services tax may not be eligible as credit to the final consumer also or to the plant also. So up to this it is fine. Now from the sales company or the stockyard or the depot, again three type of sales can happen. One is an interstate sale to other dealers, wherein again that depot raises an invoice with a CST wherein no credit is available, and if it is an interstate sale, of course an element of entry tax may be there. In case of local sale or the local sale, the company charges VAT and in VAT, and similarly if it is made to from dealers in the same stockyard to a customer, again VAT is being charged. So in this whole scenario, if we see, up to the point the product reaches the customer, there are various taxes being charged as of now, out of which there are certain credits which are not available in case of services, and there are credits of CST being paid which is not eligible to the intermediaries also, and thereby the intermediary, when they charge tax to the dealers or to the consumer, they charge tax on tax because certain portion of what tax they have paid to the manufacturer is not eligible to be set off from their output liability. So there comes the question of cascading effect in the current taxation design. Now, if we see how would GST, keeping all the purchase sales same, how would the GST model be working? It is to be seen in this slide. See what we have taken here, all the things remaining the same. In case of import by the manufacturing plant, there will be no CVD, there will be no ADC, no service tax, no entry tax. It will be only the basic custom duty and IGST. Means all the import taxes other than the basic custom duty is being replaced by IGST, means the integrated or the interstate goods and service tax, which is eligible as Senbert credit to the manufacturing plant. In the earlier slide, if we see the CVD, the CST credit was not eligible in case of interstate purchase, was not eligible to the manufacturing plant. But if now the manufacturing plant procures interstate materials also, then this IGST would be charged and the whole credit of the IGST being paid. Of course, subject to the compliances in this regard, means the tax being paid, the return being filed on time, the credit would be available to the manufacturing plant. Further, the manufacturing plant again transfer this to the sales company or the stockyard, wherein instead of CST, if it is in the same state, the plant would be charging CGST and SGST. CGST to replace value added, to replace the central excise duty, and SGST to replace the state VAT. If it's an interstate transaction, then the manufacturing plant would be charging only IGST, wherein the credit of IGST would again be eligible to the company whom the manufacturing plant is selling. Similarly, the supply chain goes forward, wherein the dealers again charge CGST and SGST if in the same state, or they charge IGST if it is a interstate sale by the dealers, and thereby the product reaches the customer. In this whole chain from the last slide and this slide, we see there are a lot of instances wherein CST was being charged, and now that CST is being replaced by IGST. And IGST is one such thing which the credit of which is available to the person who is purchasing that. Thereby, the final cost to the consumer going down to a certain extent, because at each level, the retailers or the distributors and the dealers would be having Senbert benefit, thereby the final price being less to the final consumer. Of course, these are based on certain assumptions. Assumptions as in all the rates in all the states with the GST coming into picture also would be uniform. But as per the proposed GST model law, the states would be given certain powers to levy for the purpose of rates of taxation to suit their eligibility, because certain states may be losing on account of GST, therefore that power has been given. But ultimately, how much power would be exercised by state would be determined by the GST Council. How will the GST work? Just a brief example. Suppose there is a manufacturer. The manufacturer procures raw materials, stores and spares and services, the basic cost being 120 and 50 totaling to 170, and assuming the GST rate to be 20%, the manufacturer pays 34 rupees tax on his procurement of raw materials, stores and services. Now when the manufacturer sells the product to the next level, suppose the basic price with his costing 170 and adding his profit margin is 200, and he charges 20% being the GST rate, so the total output tax at the manufacturer end comes to rupees 40, and the input credit which the manufacturer had paid at the earlier level is rupees 34. So the net tax payment to be made by the manufacturer to the government exchequer would be rupees 6, again subject to all the compliances as proposed in the model law for the purpose of availment of Senbert credit. by filing of returns and payment of taxes. Now, these goods are being procured by the trader. The purchase first for the trader comes to rupees 200, being the basic price of sale price for the manufacturer. The trader also incurs his service cost of rupees 80, and the cost to the trader comes to 280, on which he charges 20% tax, and on which 20% tax he has to pay to the procurer, and thereby 56 rupees is the total tax being paid by the trader on his procurement from the manufacturer. On the sale of the same product by the trader, suppose the basic price is 350 rupees, where the cost was 280 and the sale is 350, assuming GST rate to be 20%, the tax collected on sale by the trader comes to rupees 70. The input tax credit available to the trader is 56, and therefore he has to pay a net tax of rupees 14. Now this final product reaches to the customer. The cost to the manufacturer is rupees 170. You can see the basic cost table for the manufacturer. The profit margin of the manufacturer is rupees 30. How? Because the sale of the product is rupees 200 price and the input cost is 170, profit being rupees 30. The value added cost to the trader is his service cost, which is rupees 80, and the profit margin of the trader is rupees 70, which is the sale price of the product for the trader, which is 350 less rupees 80 less rupees 280. Therefore, the profit margin of the trader is rupees 70, and the total price comes for the consumer is 350. On this rupees 350, assuming GST rate to be 20%, the tax paid is 70 rupees, and total price of the product comes to rupees 420. So if you see in this slide, the tax received by the government at all the stages is rupees 24 at the stage of manufacturer. Tax paid by the service provider is rupees 26. Tax paid by the manufacturer is rupees 6, and by the trader 14, and the final tax collected by the government is rupees 70. Now we have certain questions coming in also. We have a question which is wherein it is being asked, can you please explain again how tax evasion will be checked? Sir, tax evasion is a thing. How it will be checked? I can just tell you as of now is that with GST coming into picture, there will be lot of trails of documents which has to be maintained. As I have been stating earlier that I will be getting this input tax credit subject to certain compliances. Now these compliances are very important. Suppose I purchase a certain product at rupees 100 and I paid rupees 10 rupees tax on that rupees 100, being 110 total cost, and my vendor from whom I am purchased has not disclosed in his GSTR1 return his sale of rupees 100, or maybe he has disclosed that as 100 as rupees 80, then I will not be eligible to take the benefit of rupees 10 tax which I have paid to that vendor. So what is the recourse that I am left with? I have to make a query in the GSTN network. Your dashboard will be there, wherein you have to raise a query and raise the query by stating that this much tax have been paid by me under this challan, under this invoice. However, my vendor has shown this. By this thing, the department, which will the GST dashboard that you will be accessing, every individual SSE will be accessing, the department will be, the GST council will be monitoring the same through the departments of the state as well as central will be merged under GST, and through those things the tax evasion will be checked, because at each level the value addition will come into picture, and those things would be reflected. If one party is not reflecting in their returns or not paying the taxes, then the other party being not able to utilize the same has to edit the same, and after editing a pop-up will come up at the department's level. Through that pop-up, the person who has not paid may be caught, whereby he has to pay that tax along with certain interest or penalty as may be proposed, and things like that. So tax evasion, checking out tax evasion, as if we speak as of now, would be done through trail of documents. And an interesting fact I will tell you is that currently 92% of the taxes are being collected suo motu in the indirect taxes without any interaction with the revenue officers. Only for 8% of the taxes are being collected by the interaction of the CBEC and the state the CBEC officers per se. If I speak about only excise service and custom. But with GST coming into picture, it is expected if the GST network which is being developed is developed to that extent, then almost 98% of the taxes would be collected suo motu and the role of the tax officers would be minimized to a great extent. Also, we have one more question. As finished goods price, distributor price factor and conversion rate like service provider. Can you please? How will it affect the finished goods price? Sir, as we have just seen, I told you that in case of interstate purchases, the CST credit was not eligible. But since now the IGST credit would be eligible for the manufacturer, the ultimate price at each level being the SENBET being allowed, the ultimate price to the consumer will go down as because the SENBET is being eligible to the manufacturer at all the levels. Therefore, it is expected the price burden to come down. But for service sector, initial 1 or 2 year will be inflationary. Why inflationary? Because we are standing at a rate of service tax of 15% as of today, which if suppose the expected rate being 20% will take a huge hit. All your telephone expenditures, all your insurances and everything, wherein which is for the end consumer, there is no SENBET being available to the end consumer. The service sector is expected to take certain hit because the GST rates are proposed to be uniform throughout for the service as well as the manufacturing sectors. But service sectors would be impacted. Manufacturers, of course, over a period of time, it is not that at this first level the price would go down, but over a period of time, the price is likely to go down as they are proposing a uniform SENBET mechanism, and thereby if at each level only the value addition is being taxed, thereby the cascading effect of tax going down, the price to the final consumer may go down. Again, we have a similar type of question as to how will the government curb dealers who don't pay any taxes. Sir, I told you today the states have a threshold limit of 5 lakhs or 10 lakhs, and the excise we have 1.5 crores, in service tax we have 10 lakhs. But in GST being a uniform 10 lakhs threshold limit being proposed, all these small players, because see, when they also procure certain material, they procure some taxes has to be paid at each level. Now, if they do not sell that material with proper tax invoices, it is bound to be caught by the audit trail of documents. And the GSTN system that has been developed is a very high-end system wherein inputs from all the other departments from income tax and it will be matched through a PAN would be available, and thereby there may be small dealer or big dealer, everybody would be having certain impact and they have to collect and pay those taxes. We again move to the slides and then we'll take up further questions. This is just in the last slide we saw that how will the GST work as an example. Now the price reduction, as was stated in certain questions also, how would the price reduction be done? It's just an example, it's a self-explanatory example. If we can see here that suppose the manufacturer and the trader are in the same state and in the separate state, if we see this and the GST regime, then you see at the GST regime assuming taxes to be 20% at 20%, the cost to the manufacturer is 1,20,000, and for the in current regime, if in interstate it is 1,16,000, it may seem that it is less. However, when you proceed further, it is seen that a cost to the trader is 1 lakh, because this 20,000 rupees is eligible as surveyed to the trader. Therefore, the ultimate cost for him becomes rupees 1 lakh only. He adds his profit margin and he adds the taxes coming to 1,38,000 for the retailer. But in the current regime, this 1,16,280 becomes the whole cost, because these all are not eligible as a SEMVET benefit to the trader. Therefore, this whole 1,16,280 again suffers this taxation of 12.5%, thereby having tax on tax. Thus, the cascading effect comes into picture, and ultimately you see in the GST regime, of course, these are just an estimated figures. The price to the final consumer comes down because of the SEMVET chain. At every level you see the cost to the retailer is exclusive of taxes, because these taxes being paid at the earlier level are eligible as SEMVET or input credit to the next level before the consumer, and thereby the final price going down. GST rates, a lot of debate has taken place regarding this GST. What would be the likely GST rates? Some say it is 18%, some say a revenue neutral rate has to be determined. What is a revenue neutral rate? There has been committees being formed on the same. Different committees have given different rate structures. Some say it is 27%, 18%, 20%, but see, all these rates, whatever the rates be, would be determined by the GST Council. There are a lot of speculations coming that 18%, because Congress is demanding 18%. Rate higher than 20% may be very inflationary to begin with. So there are many issues there, but let us wait for the formation of the GST Council, and GST Council will finally determine the rate. And GST Council will be having the representations from the state, from the central, all the finance ministers would be there. So appropriate revenue neutral rate would be selected. Of course, for luxury items, there would be a high-end rate which is there today also. And for precious metals of articles, there would be a low rate proposed. As in VAT, today we have a 4 rate structure, like 1%, 5%, 14.5, 20%. Similarly, it is seen, or it is through our what you can say, through our talks with the government and the departmental people, it is we see a rates to be hovering around 18 to 20%. 22% of course would be a bit inflationary, but let us wait for the GST Council to determine what exactly would the rate be. In the past, what we have discussed, what is GST, the need of the hour, the cascading effect of taxes is being removed, seamless credit being eligible, increase in tax collection due to widening of tax base, as I stated earlier, because the threshold limit being only being rupees 10 lakhs for both excise and VAT turnover being included. Therefore, the tax base would be widening. Simplification of the indirect tax structure, reduction in price, all these things are required today for the Indian economy as a whole. Thus, the GST, being the need of the hour, is finally seeing the light of the day. And the government, today also it was there in the papers that the Revenue Secretary, they are working over the time, whole nights, to bring in the model laws as early as possible in the public domain. The draft law, which was released by the Empowered Committee of the Finance Ministers in June 2016, we being from through our Institute of Chartered Accountants of India and through other chambers of commerce also, we have given lot of representations to the government. We have handed over the same to the CPEC as well as to the Chief Commissioner in Kolkata, wherein different proposals which are not tax friendly have been highlighted, and our intent, let us see and wait when the model law, when the final bill is being placed in the public domain, all these queries that we have raised are being solved. Now, if we take some questions, it say one Mr. Holmes asks, sir, what will the return filing structure? See, return filing in the model law, they have not stated much of that. I expect they have a section on returns, but over the period of time, they had released a process notes on returns. Returns, they are speaking about that there will be 3 returns in a month, at least 3 returns which every dealer has to file, which will be one for the purpose of your outward supplies, means all your sale details will be given, and those will be given in the whole bill wise, means details of each and every bill during the month with the name, address and the details of the bills have to be entered in the GSTR1 return. Again they are stating with a GSTR2 return, which will be the details of all the inward supplies, which all your Senvet credits that you have paid to your vendors during a particular month, in that would be a return. But that return is expected to be a pop-up based return. Why? Suppose we take an example. I have taken a services of Mr. X during a month of April 2017, and I have paid Mr. X his bill or invoice amount along with tax amount. Suppose CGST plus SGST rupees 20 I have paid him. But that Mr. X, he has not filed his return for April, which was due by 10th of May, and neither he has paid the tax which I have paid him. So, if he has not paid the tax which I have paid him for his services, I will not be allowed to take the Senvet credit benefit of the taxes paid by me in the month of April. In my GSTR2 return, which will be mostly a pop-up based return, all the vendors who have filed the returns and who have procured my services, their list would be automatically coming in with the names and details and the amount of Senvet being eligible. But if your vendor has false, means if he has lapsed and he has not paid the taxes to the government, then you being the receiver of those services will not be eligible to have the Senvet benefit. Thus, you being left at the mercy of your vendor. And finally, there is a third return, which is the GSTR 3, which is the combined return for the net total tax payable, total input credit set off, and the net tax payable, which has to be filed within 20th of the end of the month, after the end of the month. So basically, three returns are there. Other than three returns, there is a return of ISD, there will be a return for tax deduction at source, and there will be an annual return which has to be filed after the completion of financial year within 31st December, which would be, we are expecting a form of the detailed VAT audit report which are currently there in all the states. A similar type of form is expected as an annual return. We have a question as to what about the goods sent for job work to another state? Sir, job work provisions, they have dealt it very minutely. They have just given one section on job work, but the taxation in GST would be based on the concept of supply. It is supply. There will be no concept of sale, which is there in VAT. There will be no concept of manufacture, which is there in excise. The whole concept is of supply. So if I send goods for suppose to my job worker or to my another branch also, which is into another state, it becomes a supply, and on this supply I have to pay tax and remove the goods. So as of now, supply they have stated to be the dominant character in GST. So all the supplies that you make, subject to the exceptions given in the schedule 3 contains what is, they have defined the term supply also, which is a very wide definition, and they have also given certain schedules wherein they are exempting certain supplies. But these are in the very raw form, but one needs to understand the concept of supply would be the dominant thing, and supply is being dealt, time and value of supply is being dealt in chapter 4, section 12 of the model GST Act, which says what will be the deemed to be the supply. In service tax, as we know, there is a concept of advance payment of, on advance receipt we have to pay service tax. But for the first time in the model GST law, they are proposing this advance mechanism in case of VAT also. Means suppose in case of purchase, in case of sale, if I am getting certain advance from my customers, I have to pay the CGST, SGST or the IGST as the case may be on that advance amount, whether or not that product has been manufactured or delivered. So those concepts are coming therein. Next, there is a question like, we are a distributors, trader and get job work done on stock transfer as the job work is excisable as present and get commercial and tax invoice. How will it work after GST? Sir, as I just stated, the concept of supply would be there in GST. So in case of branch transfers, job work, how will the job work mechanism be made? They have not come up with clear guidelines, but all these supplies, if it tantamounts to supply, that supply you have to remove that goods to your job worker after payment of taxes, and of course there will be statutory time limit wherein the job worker will again send you the goods which is presently there in rule 4.5 of the Separate Credit Rules. Similar provisions are expected to come in the model GST law also. We have a question as to whether there will be any benefit of being a first stage dealer after the GST gets introduced. Today, first stage dealers are mostly acting as passers of standard credit from the manufacturers, as all the final consumers may not be available to directly go to the manufacturer. But in GST concept, this first stage, second stage dealer will be holding no good. You would be acting as a trader. You procure from the manufacturer, he charges you CGST, SGST or IGST, and on your sale, you again charge CGST, SGST or IGST as the case may be. So the concept of first stage or the second stage dealer may not be relevant in the coming regime. We have a question on refund, like we got the refund which we deposited in PLA against the value addition. After GST regime, at that time, what will be the system of refund? Refund, sir, in the transition provisions chapter that they have given in the model law, they have stated that all the pending refund claims has to be adjudged as per the earlier law. As on the appointed date of GST, all the refund claims which have been already filed has to be adjudicated as per the old law. However, after the adjudication, if suppose out of rupees 100, rupees 80 refund is allowed and rupees 20 is disallowed, this rupees 20 would lapse. As of the from the wordings of the transitional provision, it is not clear whether for this rejection of rupees 20 an appeal can be filed in higher forums as per the new law. It is not clear as per the wordings of the current transitional provisions chapter that they have introduced in the model GST law. To this extent, we have also given a note in the through Chambers of Commerce and through our institute also. We have a question as to can we claim set off of entire GST paid on purchases in case we sell product at loss. Again, product at loss would be meaning your sale price is less than your purchase price. Sir, suppose if that in such a scenario, currently also there is in some VAT laws there is a system wherein you can adjust your input tax rate subject to maximum of your output. Similar situations are bound to be appearing in GST also, because your output GST would of course be less in case you are selling the product at loss. Thereby, it has to be restricted up to the limit of your output GST liability. Mr. Subrata asks, understand there would not be any concept of reimbursement of taxes in GST. Also, sale in transit would not be applicable in GST. Sir, correct. Your understanding is perfectly all right, because reimbursement today there is a concept of pure agent in service tax wherein the reimbursement comes into picture. But that also in the last to last budget, the definition of consideration was changed to bring in all the reimbursement into the service tax net. In GST regime, they will be sticking with the concept of pure agent, but reimbursement of taxes and other things would not be there, because at each point will be a point of supply, and at each point of supply there has to be a tax which has to be charged and paid on the value addition. India government revenue, yes, certain increase will come, but those increase would come over a period of time. Many things will depend upon the economic conditions at that moment of time, as well as what the GST Council, the rate, how they determine the rate. What will happen to the moderate on stock lying at the time of GST implementation? Sir, in the transitional provision, they have stated if all your stocks which are lying in your stock, all the sandbag which are lying in your stock will be allowed to be carried forward, provided those credits are being taken, being reflected by you in the returns being filed under the earlier regime. If you have disclosed those credits as sandbag credit in your returns of maybe state VAT return or the central excise or service tax return, in the GST, these will be credited as in your electronic credit ledger, and these would be disclosed as your CGST or the SGST credit. Those provisions, they are very well covered in the transitional provision chapter. How will they take the credit of excise and VAT input lying unreturned the date of invoice? As I have just stated, the question is the same. Sales return. What about sales return? Sales return, as in the current VAT regime, we take the benefit of the sales return, but that is not eligible in excise. But in the GST regime, all your returns, you have to disclose those in the returns, and to the extent the taxes being paid at the time of sale would be eligible to you as credits. As in excise, currently under Rule 16 ABC of the excise rules, those are eligible. But in the GST regime also, the sales return concept will be there because it's a common phenomenon which many industries has to adopt to. Now we again go to the discussion and we again come back to question after going forward with the slides. So in the last slide we discussed about all this, how the GST being coming, how the rates being determined and things like that. Now we come to the utilization of the input credit thing. So there will be three output taxes. There will be IGST, means the integrated or the interstate GST, CGST being the central GST, and SGST being the state GST. Similarly, all these three would be eligible as input tax credit also, the IGST, the CGST and SGST. Now currently we know excise credit can be set off against service tax against excise, vice versa is allowed. But state VAT credit is not being allowed to set off against your excise or for that matter service tax and vice versa. But in the GST regime, this is the biggest advantage wherein the IGST credit would be allowed to be set off. How will it work? We'll just see now. The IGST credit would be set off with IGST, CGST and SGST, all three. Means suppose I have purchased certain interstate goods and I have a credit of rupees 100 and I have an output liability of CGST rupees 20 and SGST rupees 10, and I don't have any other input tax credit with me. So with this rupees 100 IGST credit, I can first set off my IGST liability. It has to go in this line ABC, means IGST first has to be utilized against IGST, next against CGST, and the last against SGST if any balance remains. This phenomenon, this hierarchy has to be followed. With CGST, the CGST first has to be set off with the CGST and next with the IGST. Similarly, the SGST can be set off with the SGST and with the IGST. Setting off of CGST with SGST and SGST with CGST is not allowed, which is there in the current regime also. The current regime, as I told, there is no set off between excise and VAT and service tax and VAT. Those provisions are still being continued in the GST regime. GST next steps, this I discussed briefly in the starting of my presentation. The Constitution Amendment Bill passed by the Rajya Sabha on 3rd of August, again by the Lok Sabha by the 8th August. 50% of the state assemblies to ratify the same. Next, the bill to go for the presidential assent. After the presidential assent, the formation of the GST Council has to be done within 60 days. This GST Council will issue the draft registration and the rules for levy taxation, which will be placed in the public domain, and stakeholder feedback and finalization of GST legislation rules and the threshold limits will be decided by the GST Council. This portion has already started, as the Revenue Secretary has also already started holding meeting with power sector and oil and gas sector. He has already held meetings about the proposed GST structure and he is taking the inputs for the laws to come in smoothly. The readiness of the GST and network, which will be the backbone of the whole GST regime, and finally the rollout expected to be 1st April 17. How would the GST be? How would the business transformation in my starting of the slide? I stated in my presentation that it is more to me a business transformation than a tax reform. Why a business transformation? All these points would be being self-explanatory, would be easy to comprehend by all the viewers. Firstly, IT, you have to change your systems, the compliance, the auditability, automation, because the returns which are being proposed is a very great level detailed returns wherein each line item of your sale bill has to be introduced. So manually entering 500 sale bills would not help your cause. Therefore, accordingly, your IT has to be involved wherein systems has to be developed so that all the data can be generated in Excel and be automatically uploaded in the GSTN network. The tax accounting, the procedure to pay, the tax payments, the tax credits, all the things would undertake a change. Your capital projects costing, pricing, forecasting, the logistics cost, the distribution strategy in supply chain, the inventory management, all these things would be having an impact with the taxation regime being changed. And of course, the compliance and the change management, the GST awareness training, the communications with the department, the organizational structure has to be worked, and of course, the compliance with the registrations, the transitional provisions, very important. The most important of the provisions is the from section 141 or 1 to 163 of the model act being proposed and the return reporting. So all these things coming into picture, there will be huge change in the way the business is being conducted, and therefore I call it as a business transformation. Now we come to a question wherein Mr. Chatterjee asks, what would be the impact on companies having plants and stockyards in multiple locations in the country? Will it help to bring down the cost? Sir, firstly, I would like to clarify. Now, there is a concept. Suppose you have different stockyards and plants. For excise, it is fine. You have separate registration currently also. But in service tax, you could avail of centralized registration as of now. But in the proposed GST regime, they are coming with a concept wherein every person has to register in each state. So the number of offices or the number of states you provide service or you have your plant, for each state you have to take separate registration. Of course, they have also proposed vertical wise registration, wherein suppose FMCG company who has different verticals and has factory in a particular state, 2, 3 factories, or a single factory manufacturing various products, they may opt for a vertical wise registration. But all these registrations would have to be tagged with your input credit, because vertical wise registration, one vertical cannot exchange standard benefit with the other vertical because it becomes a separate entity. And in case of state wise registration, which is a compulsion, there is a concept of ISD, input service distribution, which is also being proposed in the current regime. So the credits would be of course distributed. Multiple locations, advantages, it is currently what you are having, the cost can come down because your procurement cost at each level when you do interstate transactions would come down because of the IGST credit being available. And next, the tax rates being uniform all over the state, subject to certain powers being given to state, otherwise being uniform all over the country, would come down. Suppose a product of HUL being sold at West Bengal will be sold at the same price at Maharashtra also. So through that action, we see a cost reduction be coming in times to come. We have a question as to the treatment for hill states like Himachal, Uttarakhand, where there is excise exemption. Sir, this has to be taken with the respective states. I can tell you about Northeast, wherein in the Northeast, in the last budget, the finance minister there has already confirmed that all the benefits which are continuing in the Northeast would be also be continued in the GST regime, but a cap would be there. And similarly, in Himachal and other Northeast states, Uttarakhand, we believe certain mechanism is being drawn by the department, by the GST committee and the GST commissioner to see how the existing benefit, because many people have invested in these states to set up new factories and manufacturing locations. So certain things, as of now, the model law does not deal with any such exemption being given. But in transition provisions also they are not spoken about. But it is believed that these exemptions would continue up to a certain time, subject to certain restrictions again being given on them. What would be the impact on service provider which are coming under RCM? Sir, RCM concept still would be valid in service in the GST regime also. They have they have given a provision wherein the government may list down the services on which reverse charge may be paid, on which reverse charge the GST liability has to discharge. So not much changes as regard reverse charge. They are continuing with the same. We have a question as to what will happen with the assessment audit of existing department after applicable of GST. Sir, as of now, two views are there. The Revenue Secretary in last week in his statement has stated that there cannot be dual control with the single SSE. Means, but earlier in his statement, he has stated no SSE would be subject to dual control by state and central officers also. But as of now, with his latest statement, it is seen that there cannot be any dual control because there would be lot of compliances hazards coming up. Suppose for me, for the SGST, I have shown a sale of 100 rupees, but the CGST officer may say no, this 100 is 120. So he may issue a show cause. But the SGST officer may have agreed to my sale being shown as 100 rupees. So there are multiple issues which will come up with this dual control of the GST by the different departments. But as of now, we believe there will be a single control. Modalities are being worked for. We have a question is if advance payment is received from the customer and after 2-3 months if services or sales did not happen and returns were filed, can the GST standard be reversed in such cases? Sir, sales return concept and deficient provision of service concept will be continued in GST. All these things has to be issued through debit notes and credit notes. Currently in Rule 4 of the Service Tax Rule, there is such Rule 6 of the Service Tax Rule, there is certain provisions for service tax SSEs and Rule 16 of the Central Excise Rules for the excise SSEs. But those are one way, wherein only one debit note or one side credit note would suffice. But in the GST regime, if I issue a debit note, then the opposite party also has to issue a credit note, and disclosure of these has to go in the respective returns. Then only the refunds and the credits of earlier sale would be allowed. In case of transfer of material, means branch transfer, I have already stated all the branch transfers would be deemed to be supplies, and all on these supplies tax has to be paid and then given, because there is no exemption, at least in the Model GST Act which was released in June, exempting inter-unit transfers. We have a question: if a registered dealer has not paid taxes against the supply he has made for which purchaser has already paid the tax amount charged, so instead of restricting purchase, why supplier is not nicer? This has been introduced lately in Maharashtra and also in West Bengal, wherein for the false, customer is being left at the mercy of the vendor. But in higher forums, if it can be proved that the credit was actually paid by the tax was actually paid by me to the vendor who has defaulted, a proper remedy may be given in higher forums. But the government is of the view, if tax is not being collected by the government, they cannot allow any businessman to avail this amendment. Of course, this is against the public interest. There are people and industries who are with this GST, the law being coming into more clearer form. Many public interest litigations would also be made for these certain kinds of provisions which are actually harmful for the industry as a whole. But let us see, and we have to wait for the draft bills, because this is also a recommendation in our from our institute wherein we have stated that this provision should not be. If I can prove at that level that tax has been paid through proper channels, then at least credit should be allowed to us. Abatement scheme in service tax, they have not stated anything, but of course they have given powers to the GST Council, who on recommendation from the states and the central may propose certain abatements. Assessment procedure under GST, so it's a vast topic. We are here today discussing the basics. Assessment procedure, I can just tell you, it is being dealt in chapter 12 of the model GST law, with audits and demand recovery provisions are there. We have a question as to how will the GST credit be taken on existing stock which have been purchased on excise part GST paid or VAT paid. Existing stock, suppose as on the appointed date, whatever stock you have, if all those credits are reflected in your return, then of course that credit will be eligible to you under the transitional provision which I have already stated. Will excise duty also levied in addition to GST? No sir, GST, central GST, CGST would be subsuming the excise duty portion of it. However, on import, BCD would be levied separately, and all the import duties other than BCD would be subsumed under IGST. Reverse charge mechanism, I have told they are proposing. If a company has two neighboring plants for different stages, will they be able to utilize the credits? So it's a peculiar scenario. In such situations, I believe you have to make a representation to the concerned commissioner of the GST at that moment of time, and accordingly, after making safeguard of the duty and certain restrictions, he may allow to set off those credits. Return replacement goods we have already dealt, wherein we have to exchange debit notes and credit notes, and to that extent the details have to be given in the respective returns, and then the credit can be automatically head off. Proposed GST model, as we have seen in the earlier slides, there is a concurrent dual GST which will be running in India, because GST would be a central and state as well as IGST. So it's not a foolproof GST model, but it's a concurrent dual GST model, which is destination consumption based, means where actually the product or the service is consumed, at that state government would be getting the revenue. Thus, loss for the manufacturing states, and the full input tax credit of IGST, CGST, HGST would be available. A single PAN based registration would be given. As regard registration, I just tell you that as on the appointed date, all the existing VAT, service tax and excise SSCs would be given a GST number which will be provisional and which will be confirmed within a period of 6 months, provided certain further documents which will be asked for by each dealer, by the department from each SSC has to be furnished. If those documents are not furnished within 6 months, then the registration would be deemed to be cancelled. Example of interstate GST, if we go through, this is a classic example of an interstate GST. Just we have discussed some time back about how this GST, the whole transaction will work, how the IGST will work. Suppose I am a manufacturer in West Bengal and I procure a raw material from a seller in Maharashtra. He charges me rupees 400 and the IGST, assuming the rate to be 20%, rupees 80. And I purchase certain products from within the state also. Now, if I sell the product from West Bengal to a purchaser in Haryana, I will be charging basic price as well as IGST, and if I sell it within the same state, I will be charging basic price, CGST and the SGST. Now in the total, the books of manufacture in the West Bengal, he will be earning credit of rupees 80 of IGST on purchase, of CGST of rupees 3 and SGST of 2. His output liability of IGST rupees 60 on interstate sale, of rupees 6 and 4 of CGST on intrastate sale. And the ITC balance is like this. See, the important thing we need to discuss in this slide is how this 10 comes. In my earlier slide, I have told that IGST credit can be utilized to first set of 60 rupees IGST liability, then the CGST and then the SGST. So 80 minus 6 minus 4, 10, and 3 and 2 of the CGST is being carried forward. This is how the interstate transaction would work. Proposed threshold limits, we have already discussed. What is the components of the aggregate turnover? The aggregate turnover, they have stated that all taxable value of all taxable supplies has to be considered in considering this rupees 10 lakhs of the aggregate turnover for taxation purpose. However, certain exemptions would be notified in due course by the GST Council, wherein certain like drugs and important documents, important medicine sectors and those sectors would be receiving certain exemptions from taxation, or the threshold limit would be increased. Of course, the GST Council will be proposing that. Now we come to the major tax impact areas. If we see, the manufacturers, in case of tax impact areas, in case of manufacture, concept peculiar to excise may not be relevant. Deemed, today we have certain concept of deemed manufacture, packing, repacking, MRP valuation. All these things would be done away with, and a fresh and a concept of supply would be there. Input credits, potential increase in the credit pool would be there. Reversals on account of trading. Today there is their rule 6, we have to reverse certain amount as of trading. Those concepts may not be there in the GST regime. The taxes on travel and stay, accumulated transitional credits, they are allowing through the transitional provisions, provided they are carried forward in your return. It is very important. In the transitional provision, they state what are the credit there in your return. Only those would be allowed. But for capital goods, as we all know in excise, 50% is available in the first year and 50% in the second year. So all the capital goods supposed purchased in the current year 16-17, the 50% of the same would be eligible as credit in the GST regime, subject to certain conditions such as procurement of the original bills, invoices detailing the credits and the proof of the payments made. All those things would be there, and accordingly capital goods credit 50% which is left and which is not there in the return also, because there is no mechanism to show that, would be there, would be eligible in your electronic credit ledger. In case of branch transfers, it would constitute as supply. The 1% additional tax in case of interstate movement of goods which was proposed has now been done away with the Congress not supporting the same. It has been done away with now. And predetermined sales, in case of high C sales, the concept of high C sales and the CST would also come into picture. Major ECA impact and SME impact areas. First, compliance and IT. Increase in compliance cost. For the first year, of course, it will be an increase in the compliance cost, because you have to understand the mechanisms of filing the returns, the process, the ways of getting registered, the ways of getting knowing the law, alignment of your IT systems with the new processes of the new refund, of the new return, of the new registration and the new payment processes. All these needs to be aligned with your IT systems, maybe SAP, maybe Tally, maybe your ERP. So first year, increase in compliance cost is being seen. For SME manufacturers, presently 1.5 crore is exempted from paying excise duty, would be liable to pay full rate of GST. The exemptions being reduced. So the tax base of the government is increasing. Another major impact area. However, with many more players coming into the market, there is a call for stiff competition between a particular sector, suppose the furniture sector or the consumer of steels or the steel rods and things like those. So those many persons, the smaller dealers would also be coming into the excise net, the GST net, and thereby the competition being increasing as per the economies of scale may bring down price to certain extent. Reduction of tax incidence can take place in case of manufacturing sector wherein currently excise of 12.5% as well as VAT of 5% or 14.5% is being levied. A rough tax incidence currently in a state vary from 20% to 27%. In GST regime, if the proposed rate is at 18%, then a manufacturing sector, the ECA sector may see a drop in the total tax incidence, thereby the cost to the consumer being also decreased. Trading entities will benefit as it will create a single uniform market. There will be no concept of first stage, second stage dealer. All will be supplying, will be procuring and supplying. And at each supply level, the tax has to be charged, and on the value addition, the differential tax has to be paid. Economic growth, some optimistic estimates suggest a 2% add to the economic growth, but these are only numbers. Only once the system is in place, we will be able to see how it goes. Credit benefits, again, since the CST burden would be done away with, all your interstate purchases for the ECAs and the SMEs would increase the credit pool and avail the complete tax incentive paid on procurement on interstate purchases and local purchases and services like power, telephone. Reduction in litigation is a very important thing because today, as I told earlier, only 8% of the taxes are collected through litigation. So with GSTN coming into picture, it is expected that it will come down to 2%, and thus the litigation would be also reduced as it will be more as today also it is of a self-assessment regime. In the coming time also we expect it will be a self-assessment wherein SSC himself has to file the returns and over a period with the annual return also, and the annual return may contain a reconciliation of your final audited books of accounts and your details of which have already been disclosed in your returns. And if a complete reconciliation of the same can be given by the SSCs with the annual return, I don't think so any litigation may crop up. But of course, there are provisions of audits and those which will continue in the GST regime also. But one needs to understand and see how much impact will they have on the outcome. How much tax revenue will be generated from these anti-evasions, SIVs and the DGCIs and the other Bureau of Investigation and other departments of the government for the collection of tax. Inventory led model, SMEs, ECAs will have a smoother and efficient inventory model to operate as at each level value addition you have to pay tax. Accordingly, the procurement will be determined and accordingly the supply will take place and accordingly the inventory model can be churned out. Next, we come to certain questions next. What about the capital purchase inputs of visit and inputs of VAT and excise? Do we get reversal of capital inputs on the trade? Sir, capital, as I told you, all the credits which will be there in your return will be allowed to be carried forward in your electronic credit ledger. For your VAT credits, it will be SGST. For your excise credits and service tax credit, it would be CGST. And as regard reversal, yes, reversal on your trading thing. Currently, there is under Rule 6 of the CCR for excise service tax is there, but such provisions are not expected in the GST regime as such reversals would close the Senmet chain and the impact of cascading effect, which is the intent of the government to not to have cascading effect of taxes, would again come in. So we have to wait for the final drafts to come in by September end or October mid, so that we can see whether those areas, as of the current thing, they have not proposed such things. How GST will be applicable for resale goods means second-hand purchase. Sir, at each point of tax, if from those things also your turnover is rupees more than 10 lakhs, then whatever is your purchase price and your value addition to the same, at each point of supply, you have to pay tax. There is no certain any separate mechanism for second-hand goods and things like that. Every goods and service would be taxed at the supply point of supply. It would be the major thing. They have a separate supply. The point of they have in the IGST Act, in the Integrated GST Model Act that they have proposed, they have given with the concept with what will be the place of supply of goods as well as services, which is currently linked with the current place of provision of service rules in case of service tax, and excise it goes as a destination based consumption wherein the goods are destined. That is a point of supply for goods. C form, H form, F forms are no such forms as of now being proposed in the model GST law, as there will be no, all the branch transfers will be taxable, the CST will be done away with. So we don't see any CHF forms in the near future in GST regime. However, existing forms which are there and up to the time the assessment is completed will have to be procured. Otherwise, at the assessment time, litigations is bound to crop up. They will concept as of now silent, but again, since every transfer would be a supply and a tax invoice has to be made with it, on which GST has to be charged, I think this would be there would be no requirement of waybills in near future, and it seamless work all over India can be done sitting in any place. So this was all from our end regarding this brief discussion on GST. I hope all of you enjoyed this. The PPT is there as a download available in your handout section. You can very well download and use the same. And we thank you all for joining the session. Thank you very much.